So this is the second part of the video. First part of the video, we discussed what are fair valuation gains, how do they arise, what are different accounting of financial instrument. That being discussed, the another part, that is the part that we would discuss in this video, is regulatory aspects. So what are regulatory aspects? How the fair valuation gains are treated. These regulatory aspects we deal about fair valuation gain. This is how fair valuation gains, what are their regulatory considerations, different types of other definition of pre-reserves. And so I think for part one, understanding of part one video is very important. At this stage, if you've not seen it, I would recommend that please see this video and then come back to this. We would just go ahead with the discussion in continuation with the first discussion only. Okay. So here I would like to see that, yes, first we come to the free reserves definition under Companies Act 2013. So when we talk about the free reserves definition, it says that any changes in carrying amount or asset or liability recognized in equity in surplus profit and loss account measurement shall not be treated as free reserve. But however, we have discussed the fair valuation gains under Ind AS arises because of change in carrying value of the asset itself. I took an example that 10 rupees share became a 12 rupees share and there was a 2 rupees gain. So these gains are coming in. So these are basically unrealized gains. They were basically changing carrying value of the asset that are coming into your PNL or OCI, but impacting your equity. So free reserve, when you talk about, it's about talking about equity portion. Your equity portion currently has. So free reserve definition has a very immense significance, because when you talk about bonus share issuance, declaration of dividend, all this consider free reserves definition, because bonus issuance or dividend can only happen from free reserves. Hence, it's very important to understand that. However, here it says that any carrying value changes or unrealized gains will basically be excluded. So if we talk about OCI considerations, I would just show you the balance sheet over here. Yeah. So when you have about OCI considerations or fair valuation gains over here, these fair valuation gains would be removed from the equity. These reserves are there, but you have to exclude fair valuation gains because free reserves definition specifically excludes them. That is the part I would like to note at this stage. Hence, free reserve any fair valuation gains excluded from the definition of free reserves. You cannot declare dividend out of it. You cannot issue bonus shares. Any fair valuation gains. However, an important question comes up: what happens to the losses? I will discuss it at the further stages. First, I would like to discuss the definition of net worth. Now, why is the definition of net worth important in the Companies Act? Because many of the regulation, applicability of the many of the provisions are determined based on what the net worth of the company is. Now, net worth of the company, for calculating it, there is a specific definition. It writes that all reserves created out of profit, securities, premium, debit, and profit balance should be considered. Here, the net worth, 2 points note. This net worth definition does not refer to free reserve. It directly says all created out of profits. Another point, it does not talk about anything about unrealized profit or unrealized gains. This is a simple direct point over here. It does not. So when we talk about what happens to fair valuation, we do not get much guidance from the net worth definition. However, going ahead from the definition of free reserves itself, free reserves definition becomes of quite importance over here. For the net worth, we already discussed that. Just give me a minute. For the net worth, we already discussed that these considerations, when we talk about for the net worth purposes, so here you would see that there is no specific guidance given over there. Now, in lack of this specific guidance in this respect, I am more inclined towards considering that for the net worth purposes also, taking reference from the definition of free reserve itself, the any OCA gains would anyway not be considered because it's clearly written out of profits. So OCA gains, I'm very sure that OCA gains or losses would not be considered. Losses we will discuss at later stage. Profits would not be considered. However, when you talk about FVTPL gains, FVTPL gains, any fair valuation gains should also be avoided. We in the net worth, it would not be included because if you are not considering it for the free reserve itself, not considering for net worth doesn't make sense. So for the net worth purposes, also for Companies Act 2030, the FVTPL gains would not be considered. For losses, of course, there would be a second part. We'll discuss about it in the next slide. So as we discussed already, the dividend is declared out of current year profits. Hence, previous year profits, only free reserves out of which you can declare dividends. Hence, we are more inclined towards to believe that as these are defined that way, Dividends cannot be paid or bonus share cannot be issued out of fair valuation gains. Neither dividend nor bonus share out of fair valuation gains, either it's FVTPL or FVOCI, not allowed. Another point to discuss over here, what happens to the losses? We, in our opinion, though the gains are being ignored, losses should be considered. It's the basic principle of conservatism that gains should be ignored, while as unrealized gains should be ignored by any anticipated losses should be considered at this stage only. Going ahead from the conservative definition itself, a basic example, if I take the particular payment of dividend or declaration of bonus issuance might result in reduction of equity. I would just take a simple example. An entity had a profit of 100 rupees, while there was a loss in OCI of 90 rupees. Now, if the entity declares a dividend of 15 rupees, I said that the OCI already impacts your equity portion. So equity portion has already been reduced by 90 rupees and increased by 100. So there was a net increase in your equity portion by, say, 10 rupees. However, this year you paid out a dividend of 15 rupees. Hence, what happened is your particular amount of reserves went down, your value get down. So this might result in reduction of your equity. This reduction in equity is something that we do not envisage. Hence, we are of the view that it's always prudent that the fair valuation losses, both OCI as well as CPL, should be considered, while their gains should be ignored while we are determining the limits for the declaration of dividend bonus issuance. Net worth purposes, our stand remains the same. I would just take a simple example to consider it. As I stand for all three, net worth, dividend, bonus issuance remains the same. See, take a simple example. You had a retained earning of 5,000, okay, and general reserve of 6,000 rupees. There were fair valuation gains of 2,500 and fair valuation losses of 1,500. So basically, these 11,000 includes these two, but with their consideration has been taken separately for just for the understanding purposes. Now, when we say what would be the treatment, retained earnings you would add up, general reserve you would add. Then on the you would see that fair valuation gains. I'm saying we do not want to consider fair valuation gains. But the general reserves, I already said that these particular FVTPL gains have already formed part of your profit and loss account. Hence, these are already there in your general reserve. Hence, we will deduct it out because they're already part of it. So we'll remove. We do not want to consider them. So we'll minus them out. Further, there are FVTPL losses. As discussed earlier, we want the losses to be considered. We are wanting that the losses should be there. And they are already adjusted because these are the fair valuation losses that are treated through fair profit and loss account. Hence, we would not adjust anything over here. However, the things change when you go to OCI because here you need to understand that the general reserve is already impacted. General reserve or retained earnings is already impacted by my FVTPL gains and losses, but FVOCI is not impacted them. FVOCI is shown separately. It's a separate part, though it is impacting my entire equity, but not the general reserve or retained earning. So here I would see that fair valuation gains I would ignore because I don't want to consider, but I want to consider fair value losses. So I will deduct it. That is all the discussion. So this basic example, hence the 1,000 rupees. So when I talk about how much dividend or bonus issue, how much reserves is available for you to declare dividend or issue bonus, or what's your net, what all the reserve would be considered as a part of your net worth, it would be 1,000 rupees only. That is what our stand is. Now coming back to the managerial remuneration. So coming back, basically, what is managerial remuneration over here? That's section 198 prescribes specific guidance for calculation of profits for section 198. These profits calculated as per section 198 are used for two purposes. One is managerial remuneration, how much managerial remuneration can be paid out, and another is CSR. These two aspects are determined for section 198. Now when we talk about section 198, the section 198(3) prescribes that in making the competition offers, that credit shall not be given of following sums, any amount representing unrealized gains, notional gains, or revaluation of assets. It's clearly given that the fair valuation gains or notional gains, unrealized gains, revaluation of assets would not be considered. Hence, at this stage, we will be ignoring any fair valuation gains for the purpose of managerial remuneration. Hence, managerial remuneration cannot be made out of any gains. However, there is another clause to section 198 or subsection 198(5), which talks about the deduction that would be provided. So what all items can be deducted? Over there, it is given that any change in carrying value for the item. So 198(5), particularly prescribes what all deductions would not be required, what all items would not be required to be affected to, or what all item would not be required to be adjusted to. So there it's given any chance in carrying of asset or recognizing the equity reserve, profit and loss account, or measurement of asset. So any such losses, hence, any such losses would have to be considered, would not have to be considered. Generally, what we have taken as view is FVOCI losses or FVTPL losses we have been subtracting for net worth, issuance of bonus or other. But for the purpose of section 195, we would not consider the losses as well. So we would ignore both uh, gains, fair value gains, fair value losses. Both would be ignored for the case of managerial remuneration, and as well as for the CSR, because section 198 would refers to CSR as well. Again, a simple example: profit and loss account. You had 5,000 rupees. So of course, these 5,000 you can of course pay out managerial remuneration out of this. Fair valuation. So this is the basic calculation of section 198. Fair valuation gains and losses, if any are there, you would deduct it. I said the gains would have to be ignored. It's clearly given. So I would subtract it out. Then if there is any fair valuation losses, these are already impacted. But what we told is we have to ignore this fair valuation loss. We do not have to consider it at all. So what I would do is I add back. Previously we ignored it, but here I will add it back. However, when you talk about OCI, both the items, gains or losses, we do not want to consider gains, and we do not want to consider OCI also. And these items not at all impacted also my profit and loss account. So I do not want to adjust it. So when I talk about managerial remuneration, what would be my profit as per section 198? It would be 4,000 rupees. This is a simple calculation. Now we'll move ahead to compliances for NBFCs. Now, as most of you might be aware that for the purpose of NBFC definition, the RBI has given a definition of NBFC that says that more than 50% of the assets are financial assets, and more than 50% of your income is financial income, then you're classified as an NBFC. Now, for the purpose of classification as an NBFC, your financial instruments, your financial statements would be containing both gains, fair valuation gains and losses. What happens to these fair valuation gains and losses? Here also for guidance, RBI has came up with a circular implementation of Ind AS for NBFCs. In that particular circular, what RBI says is regulatory ratios, limits, disclosures shall be based on Ind AS figures. In addition to this, the circular this circular was in 1990s somewhere. So that circular itself that prescribed the 50/50 test or the NBFC classification test, popularly known as PBC. So the PBC test itself, it says the figures as per last balance sheet would be considered. That is what is given in that circular. Considering these two prescriptions by RBI, we are of the view that when we talk about computing the income side, fair valuation gains that are under P&L would be considered as it is. Fair valuation losses as they are into the income, that would be considered. However, any OCI items would be ignored, because what we would see is simply the balance of the balance of the P&L account, how what all incomes are coming in, and it will simply based on that. For the income side, when you talk about the asset side, as the RBI circular said that the figures as per last balance sheet would be considered, latest audited balance sheet would be considered, we will take the balance sheet figures as it is. So there is a FVTPL, we took the gains as the income and the increased value of the asset at the balance sheet as well. It's particularly in parity. FVOCI, there is a difference. The fair valuation gains that you have considered as income, that you have not considered as income, sorry, fair valuation gains under FVOCI have not been considered as a gain. So you would just simply be ignoring the FVOCI income. However, the asset that are accounted under FVOCI, those value have already increased in the balance sheet, but you will consider that increased value of asset only for determining financial asset. That is what is the general view. That is for the PBC. A detailed discussion can come on what happens for the capital requirement at least. Or give you a general basic overview of what are the capital requirements for NBFC. A general capital requirement for NBFCs, the NBFCs are required to get a certain portion of their capital from specified sources. These specified sources are mostly own funds, that is equity. So NBFC, just to minimize the risk, are required to get their capital out of a particular portion, equities and all that. So for that purposes, your reserves are also considered, and your already retained earnings are considered for the purpose as your own funds only. So these own funds, would that include your fair valuation gains that because these fair valuation gains are forming part of your equity. In this regard, the implementation of India's circular that the RBI has already come out with gives the ample guidance on it. But the circular says that any fair valuation gains would be ignored, while fair valuation losses would be considered. This is a common statement for both FVTPL and FVOCA. Any fair valuation gains would be ignored, while net losses would be considered. The language would available over here. Any unrealized arising from the fair value financial, including gains arising from transition, should not be included in own funds, whereas all net losses should be considered. Based on this, our treatment would be there. Here, one thing that I would like to understand is that FVTPL, when you talk about FVTPL, these gains have already formed part of your equity and they're already sitting in your general reserves. But I want to talk about FVOCI, these gains and losses have not impacted your equity. They have impacted your equity, but not your general reserves part till now. Hence, the consideration would be accordingly. When we talk about own funds, we generally we ignore the OCI balances, we take the equity side of it, the reserve side of it, before the OCI balance, and then we make the calculations to it. I would take a simple example. Yeah, a simple example. So you had a paid up equity balance of say 2000. So of course you will take the entire paid up as your own funds. Now you have profit and loss account. It has 1,000 rupees of profit this year. Now this is the bifurcation of these items. So you had an interest income of 800. Basically, it's your income. You simply add it up. Now what happens is that there is a fair valuation gain and a fair valuation loss. Now this fair valuation, basically you had a gain of 400 and a loss of 200. One thing to note this stage is the circular uses the word net. Should not be included. Any such gains arising, net losses. So both these unrealized gains on a net basis should be considered. So what we would do at this stage is we would take a net. So there is a net gain of say 200 because I had earned 400 and 200. These have already been formed part of it. Your profit and loss account will not be considering it. Okay, this is a simple. You will deduct it out because there is a gain. This gain would be deducted out because we want to exclude it out. These gains would not be considered. However, when we talk about fair valuation, OCI gains and losses, these have not been considered. So if there is a gain, I would just simply ignore it. I would not consider it. But if there is a loss, this loss have to be factored in. I want to subtract it out. A very important point to discuss at this stage is that whether there is a gain or loss will be determined on the net basis. I'm not checking each item, 400, minus it out, 200, add it up. We are not doing that up. Or of the 500, ignore it, 600, you just add back. That's not the thing. Deduct it out. We're not doing that. We are checking out the net basis. We'll check on the net basis if there is a gain. Yes, so it's a gain. We need to ignore it. We'll subtract it out. If there is a loss, FUSA loss, it has not been factored in. We want to factor that in. Losses we want to factor in. Hence, we would consider it and deduct. Hence, the calculation own fund would come at 2,500. Here, 2,500, you are able to determine the own fund. However, another point comes at calculation of CRAR. The implementation of India's circular also says that any value, because of this, we deducted this portion. So any fair valuation gains that are deducted would also be deducted from the risk-weighted assets. So what I would do is, how I would calculate CRAR, I will take that also in brief. Let's say you had a loans of 2,000. There is some mismatch over here. Basically, this would be 10,000 and 10,700. So when you talk about the gain, let's focus on this last column over here. That what you would do is you will take the amounts of assets that you have, 10,000, 2,700, and then you would go and adding up all the assets that you have. You have a total assets of gross rated assets 25,200. When talk about this 25,200, then 200, if you remember, there was in the previous slide, there was a fair valuation gains that we deducted. Now this fair valuation gains of 200 would then be deducted from your risk because we have already deducted from the net own funds. We are not wanting to give us two impacts. So we'll deduct it from the fair valuation gain, net own funds also, and the risk-weighted assets also. We'll get a total value of 25,000. We had a own funds of 2,500 against it. Hence, we have a CRAR of 10%. That's what the calculation entire of CRAR would work out. Till now, we had a long discussion into this video. This is a summary of entire discussion that we had. Hope this video was of use to you. Thank you very much.